But a lot of people are also sensing that that might not be true and feeling like we're about to go into a recession, a global recession perhaps.
Right.
What's your read on everything?
We probably are in a recession. The thing is, the official scorecard, this is for the United States, not the world. A world recession is rare, by the way. Usually, one sector, Europe or the United States or Asia could be in a recession. Others might be doing better, trying to pull the world economy out a bit. But a global recession, they do happen, but they're quite rare. But just with reference with regard to the United States, there's this National Bureau of Economic Research. It's a bunch of egghead economists up in Cambridge. They're the official, unofficial scorekeepers. So they tell you when you have a recession, when you're out of it, et cetera. And that's widely accepted. The problem is they usually tell you you've entered a recession about 6 months after it's over. So you can't really rely on them. So you have to look at a lot of other metrics, predictive analytics and so forth too, if you want to either predict it or just kind of know it in real time.
So you're saying the US may already be in a recession. What are the markers? What are the markers?
Well, there are a lot of them, but one is, the Federal Reserve Bank of Atlanta has a tracker. It's called GDP Now. It's actually pretty good. Some of these statistical methods, certainly the ones at Wall Street, aren't worth our time. But the Atlanta Fed is a pretty good tracker. It went from, round numbers, kind of positive 2.4% for the first quarter of 2025 to negative 2.7% in a matter of days. And it looks like an Acapulco cliff dive. It went straight down. And they said, well, the reason is because of Trump's tariff proposals, and he puts them on, takes them off, no one really knows. But because of that, there was a surge of imports. People were trying to actually get stuff into the United States before the tariffs hit. And of course, imports increased the trade deficit, which decreases GDP, and that was the explanation for that. Probably something to that, but there's just a lot else going on. We're not quite at the stage of mass layoffs, but hiring hit a wall about 6 months ago, a little bit longer, where they just stopped. Basically, people weren't hiring anymore. Firing people is the last thing you do. By the time you get to the layoff stage and see unemployment going up, that's a sign, that's a lagging indicator. You're probably already in the recession because it's so hard to find people, train them, get them going. It's the last thing you want to do. So you'll, cut out the laundry bill, turn down the electricity, negotiate the rate. You'll do a lot else before you lay people off. When you start doing that, we're getting close to that point now. There's been some big layoffs announced recently, so that's another indicator that we're probably already in it. But new hiring stopped, as I say, 6 months ago. There's some technical indicators. Not to get too down in the weeds, but the yield curve is the shape of the yield curve is one of the best economic forecasting tools out there. So about a year and a half ago.
Can you stop, Jim? What does that mean? Because
Sure.
There's a lot of people who are listening to this who are economically illiterate.
Right. Well,
and they don't know what that is.
Well, fortunately, this is an easy one. So the yield curve is just, a typical curve. So the y-axis, the vertical axis, are interest rates, and the x-axis, the horizontal axis, are maturities. So the U.S. Treasury, people say, government securities. Well, okay, but there's a 1 month bill, a 3 month bill, a 1 year, a 2 year note, a 5 year note, all the way out to a 30-year bond. So that's the x-axis. So the y-axis are interest rates. Every one of those has a different interest rate. They can be close or there could be a spread. And all you do is you plot those interest rates. So what's a normal yield curve? A normal yield curve is upwardly sloping from left to right. And that makes sense. Longer maturity, if I'm going to lend to you overnight, I might want one rate. If we're going to lend you for 10 years, I say, well, a lot could happen to 10 years. So I'm going to want a higher rate. So an upwardly sloping yield curve is normal. But periodically, and it's not that unusual, a little bit unusual, you get a downward sloping yield curve where the longer maturities have lower interest rates. What does that tell you? Well, the Treasury market, that's the big money. I used to work for a primary dealer. We were one of the ones authorized to deal directly with the Fed. There are only about 20 banks with that status. So you talk to the Fed every day. A downward sloping yield curve, and this is where, again, the big money kind of sets this, the market sets this, tells you that a recession is coming. And how do you draw that inference? Well, let's say short-term interest rates are 4%. And longer-term interest rates are 3%. Or actually, the actual numbers now are closer to 5 and 4. So, but you say, well, gee, I'll take a 4% coupon, 4% yield to maturity on a 10-year note, because that's going to look really sweet a couple of years from now when interest rates are 1.5. When the recession kicks in and interest rate collapse, that high coupon is going to look very attractive, number one. Number two, bond math 101 is kind of counterintuitive, but when interest rates go down, prices go up, and when interest rates go up, prices go down. So if you believe recession is coming and interest rates are coming down, you'll lock in the higher coupon now, and when interest rates do come down, you'll have capital gains on that note. So it's a really attractive trade. So, but meanwhile, back here at the short end of the curve, 30-day bills or three-month bills or 6-month bills or whatever, that really is much more subject to Federal Reserve control. It's about the only thing they control, this idea that the Fed can control long-term rates by manipulating short-term rates, because this is just the value of a strip of short-term rates. Well, that's all nonsense. I mean, that's a theory. You can do the math, but that's all nonsense. So the point being, when you have a downward sloping yield curve, that's a sign that the recession is coming. People are bidding for those intermediate term securities. They're pushing the rate down a little bit, but it's going to look real good when the recession.
Hold on, Jim, 1 second. Sorry. Is that a sign that a recession is coming, or is it a sign that people think a recession is coming?
Well, people, but the people are the biggest institutions in the world. This curve is set by sovereign wealth funds, endowments, pension funds, insurance companies, the players in that market. It's not that they're infallible, but they are. It's basically a distillation of all the big money in the world, kind of saying something to you. And so you should kind of just not. The math is simple. The yield curve is simple to look at, but you have to know what it means. And so the downward sloping yield curve, which did start about a year and a half ago, said that the recession is coming. Now, what's happened in the meantime? The yield curve has flattened. It's actually what's called a bear flattener, where short-term rates came down a lot. Long-term rates came down a little bit, but now it's kind of flat, and it's actually getting back to a normal shape. What does that tell you? It tells you the recession's here. Now that the recession's here, short-term rates should come down a lot, and they have. And this idea that the Fed is, they do have an influence, so I don't want to dismiss them entirely, but I'll come close. The Fed is not leading the market. The Fed is following the market. The best short-term rate indicators are 1-month Treasury bill. There's something called the secured overnight financing rate. It replaced LIBOR. It's a clunky form of LIBOR. But both of those rates, the secured overnight funding and the 1-month bill, are lower than the Fed funds target rate. So what that tells you is that the market is sensing exactly what I'm describing. Those rates are going down. So whether the Fed's going to whether they cut or pause at a given meeting, I watch it, and it's pretty easy to forecast. But it sort of doesn't matter. And what I'm saying is the Fed's irrelevant. The market's taking interest rates where they need to go. So now that the curve is going from inverted, where the intermediate term rates are lower, that's the signal. Now it's flattened. It's getting into a normal shape, but all of the rates are coming down. That's the signal that the recession is here. By the way, this idea, we'll stimulate the economy with lower rates, that's nonsense. It doesn't stimulate anything. Low rates are associated with recession, depression, and financial panic. That's when you get low rates, three pretty bad things. In a robust growing economy, rates will be higher. Now, I'm not saying sky high, maybe 4%, 5%, but what that tells you is that a borrower expects a higher return. If I think I can get 10% on my investment or more, I'll happily borrow at 4% or 5%. There's also competition for funds. The banks actually love that environment. They have positive spreads. So a robust economy, you'll see interest rates of 3, 4, 5%, sometimes a little more. In a sick economy, recession or depression, you'll see rates of 1% to 0, which is where we're heading.
And Jim, there's been a lot of talk about tariffs. Trump has, said he's going to put tariffs on the Chinese products, or rather increase tariffs on Chinese imports.
Correct.
He's also gone in against the Canadians. I mean, I can't understand why. So for laymen, what is going on? And do you agree with tariffs?
Well, I always tell people who are doing their first overseas trips or just planning on going abroad, I say, if you want to go to a country that's most like America, go to Australia. I consider Canada a pretty exotic country. I lived there for a couple of years, so there are some significant differences between Canada and the U.S. Look, Trump's putting all these tariffs on. It's the best economic policy you can think of. It's extremely good for the U.S. I get in this debate all the time. I'll expand on that a little bit, but when I have this debate and I explain to people why tariffs are good, they say, for the United States, they go, well, yeah, Jim, but this is really going to be bad for Vietnam and China and Malaysia. And I say, yeah, that's their problem. Tell that our job is to make America great again. Tell President Xi to make China great again if he wants, and let him figure out policies that actually work other than overborrowing, real estate boom, and corruption and skimming and a lot else. So our job is to take care of America, and Keir Starmer can make the UK great again. That's all.
That's a highly questionable statement, but yes.
Yeah. But that's all fair. So looking at it from the American perspective, what we're seeing is a return to something called the American system. It was invented by Alexander Hamilton in 1790. His problem was first Treasury Secretary. We had revolutionary war debt and state debt that had kind of hung over from before the creation of the United States. And one of the first issues facing Congress is, what do we do about all this debt? And so Congress said, well, that's easy. We'll just default as the American way. And Hamilton said, no, we'll borrow more, use that money to pay off the old debt, and then we'll just keep borrowing and just roll over the debt. And that was the creation of the government securities market. It's been going strong for 230 years. You can call it a Ponzi, but it works. But then you had to finance the government as well. And that's where tariffs come in. We had tariffs from the start. Alexander Hamilton and George Washington took a field trip out to Passaic, New Jersey to show Washington these waterfalls. And they were like, this is perfect. This can, you had water wheels and looms and powering industry. But we need tariffs to protect us from primarily England, because they were the leaders in that technology at the time. From 1790 to 1962, the United States grew economically, geographically, technologically, telephone, telegraph, railroad, steam. I'm not saying we invented every one of those things, but we certainly applied them and invented quite a few of them. The greatest invention of all time economically was indoor plumbing. 50% of humanity spent 70% of their time fetching water for 5,000 years. All of a sudden, women were free to do more productive things. So it's a little more powerful than the internet. But my point is, that whole regime, and there were very strong advocates, starting, as I mentioned, with Alexander Hamilton and George Washington, Henry Clay, who was not president but was a powerful senator, John Quincy Adams, Abraham Lincoln, William McKinley, Calvin Coolidge, Dwight Eisenhower, all the way through, they all advocated tariffs. Now, the rap on tariffs, the Democrats ran this in the 2024 presidential campaign, and unfortunately it kind of stuck. So you have to explain it to people. They go, well, tariffs are a sales tax on the American people. That was their statement. So you have a certain good at a certain price, and you put a 20% tariff on it, the price is going to go up 20%. Sales tax on the American people and inflationary. Both of those statements are wrong. Here's why. In a tariff transaction, you have three parties, could be more, but at least three. You have the producer-exporter in China, Vietnam, etc. You have the importer, who's a wholesale or distributor, and then you have the consumer. So we are going to put 20% tariffs on things. That is going to raise the price, at least initially. Who actually pays the tariff? Well, it's the importer, the person who takes the goods off the ship at the Port of Los Angeles has got to write a check to the Treasury for 20% of the value of those goods. But who pays it economically? It is split between the producer and the importer, or it's completely pushed back down the supply chain to the producer. So the importer says, hey, I just paid 20% more. You need to lower your price 20%, so that when you, or whatever the number is, so that when you throw on the tariff, it comes out about the same. Or the importer will eat it in the form of reduced margins or profits. The original exporter, the producer, will eat it in terms of reduced profits or margins. The one party that does not eat the tariff is the consumer. There is no price increase. And why is that? Well, first of all, that's what the economic data shows. But more to the point, if Walmart or Costco or Target or Best Buy could raise prices 20%, why wouldn't they just do it? I mean, why do you need tariffs to do that? Of course you want to raise prices. The reason they can't is because the consumer can't pay it. The consumer's tapped out. Credit card lines are used up. Mortgage rates have been high. Hiring is dried up. There are a lot of, and inflation generally, we're still, the thing about the Biden inflation, they say, well, inflation went down from, it was 9.1% in June 2022. It's about 3% today, give or take. It's bouncing around a little bit. They say, well, inflation has come down. Yeah, but the 9% never went away. That 9% increase is still there. The 3% increase is still there. Prices are still going up. But when, the financial television talking heads say, inflation's coming down, people think, prices are coming down. Prices aren't coming down. Inflation is going up at a slower level, but it's still going up. And we're building on top of the 9% that we had in 2022, which was the highest since the early 1980s. So given all those price increases, which are now embedded, and the other headwinds I described, people can't afford to pay higher prices. Like I say, if they could, they would have been charged that already. So in other words, the tariff does not fall on the consumer. It falls on the producer or the importer, or it's split between them in some fashion. So the idea that it's inflationary is not true, and the idea that it is a sales tax on consumers is not true. It could affect margins further up the supply chain, but not at the consumer level. But what else do tariffs do? You basically create a wall, you create high-paying jobs in the United States. Trump has said to everyone, China, Malaysia, Vietnam, I don't know, I'm picking on them, could be French wine, well, not French wine, it's not a good example, but German manufacturers, et cetera, said, hey, you can sell whatever you want to the American people, no problem, but build it here. Put your plant in the United States. Because you got to, instead of paying the tariffs, if you're the producer, going back to what I just said, the producer bears it. Well, if you don't want to bear it, jump over the tariff wall and put your plant in the United States. Taiwan Semiconductor is spending upwards of $100 billion building new fabs, fabrication plants for semiconductors in the United States. Apple just announced $500 billion of investment in the United States. Now, they're a U.S. company, but they've been investing mainly in China and Malaysia and elsewhere around the world. So Honda announced they're building a major car manufacturing plant in the United States. I love my friends, in the upscale zip codes, they're driving Mercedes. I got a nice German car. I said, no, it's not. It's made in South Carolina. I stick to Audis because they actually are made in Germany. But so more and more of these cars are built in the United States. What we're seeing is stage 2. This is Lighthizer 2.0. Robert Lighthizer was the deputy U.S. trade representative to Ronald Reagan. He did this to the Japanese car industry in the early 80s. He saved the U.S. car industry. And the Japanese finally said, okay, we hear you, because he threw huge tariffs on them. He said, we hear you, we'll put our plants in the United States, and they're here. Now, Volkswagen's crying because they just built a huge factory in Mexico for the Audi Q5, which is one of their best-selling vehicles. And they're like, wait a second, what about, well, USMCA is the successor to NAFTA. What about those tariffs? And Trump saying, well, we don't care, we're gonna renegotiate, we're putting tariffs on that. You should have put your plant in the United States. Volkswagen, you should have thought of that. But the door's open, you can invest here. Now, what else does that?
But Jim, sorry to interrupt, and this is really interesting because only a week ago we had Liam Halligan, who you know, making many of the exact opposite points of what you're saying.
Right.
But we respect you both, and both really interesting people with interesting perspectives. If you force manufacturers to make things in America, I don't see how that wouldn't be inflationary because you have to pay people higher salaries here. So yes, you're getting higher paying jobs into the US, but you're also pushing up the price of the things that those people make, aren't you?
First of all, the salary has to be put in the context of productivity. U.S. workers are very productive. When you give them the capital, when you give them the investment, these factories are very productive. So, and as far as the higher salaries are concerned, the way the Chinese make money is they sell, I hate to be vulgar, but they sell crap. I mean, they sell stuff that falls apart before you open the clamshell box. When you factor in transportation costs, energy costs, the salary differential is not as great as it once was. I'm not talking, if it's $15, $20 an hour, maybe $40 an hour in certain industries, that's a globally competitive rate. The people who are not competitive today are the Germans. well, we can talk about that, but for other reasons. And there are only a handful of countries that really have that kind of manufacturing capability. So, but you lower your distribution costs, you lower your transportation costs, you're going to lower your energy costs because drill baby drill, and U.S. labor is productive. So the notion that you got to pay, it's not like Chinese auto workers are making $2 an hour and our auto workers are making $40 an hour. I mean, something like that, not quite as extreme, might have been true in the early 80s. It's not true today. I mean, Liam's working in a world of theory, but all these theories are badly flawed. And again, I go back to the fact that this whole tariff scheme that I just outlined was how the United States operated from 1790 onward.
Well, let me probe some more. Actually, the argument I just put to you wasn't one of Liam's arguments. Liam's argument, I think there were two things, but one of them primarily was what happens when you slap down tariffs on people. Some of them will absorb it, but with the Chinese, they're not going to be prepared to be bossed about in this way. They're going to retaliate, and that's bad for everybody because now you've gone from a mutually beneficial relationship to a zero-sum game.
Well, this is the myth of free trade. Even David Ricardo knew that free trade, there was no such thing. The problem with free trade is I had a really high grade point average in college, but I struggled a little bit with economics, and I always wonder why. I was like, was I just not bright enough, And it was only later that I realized everything I was taught was garbage. The reason I didn't get it was because it was all wrong. So one of the myths is free trade. So what they teach you is, England is very good at shearing wool and textiles, and Portugal is very good at growing grapes and making wine. It makes no sense to grow grapes in England. It makes no sense to start a textile industry in Portugal. So why doesn't England make the textiles, Portugal make the wine, and just trade? Everybody's doing what they do best, and that's the theory of free trade. You can write those equations. It's pretty simple. That's a completely abstract, artificial construct. So what does the real world look like? The idea is called comparative advantage, what I just described. The idea is like Tom Brady shouldn't mow his own lawn. He could probably mow his lawn better than any landscaper in town, but it's not the thing he does best. He should be, in the broadcast booth now and let the landscaper mow the lawn. It's better for everybody. That's comparative advantage. The problem is, and Ricardo actually recognized this, he said that the factors of production were static in that example, but in the real world, the factors of production are not static. They're completely portable. So who's the most sophisticated, largest, best semiconductor producer in the world today? It's Taiwan Semiconductor in Taiwan. Okay. That industry started in the late 1970s. What was Taiwan's comparative advantage in semiconductors in 1979? Zero. Their comparative advantage was tuna fish and rice. So they created it. They created it out of thin air. They said, we're going to do this. They started with state sponsorship, but they grew out of that very quickly. The companies went public. They were very relaxed about, if you were the hot programmer, developer in Taiwan Semiconductor and you wanted to spin out and start your own company, they would say, yeah, I'll give you the money, I'll give you the capital, create a network of those firms. Maybe people were studying in Stanford or MIT, but they got back to Taiwan. But that's the problem in China. They send their scholars abroad and they don't all come back. But in Taiwan, in many cases, they did. And now they're the leading semiconductor producer in the world. My point is they created the comparative advantage. Now, same problem with China, and there was a time, it's not as true today, but the labor was cheaper, so that was a comparative advantage, but the capital was completely portable. So you take the cheap labor that's there, and the capital, which is portable, which went to China. Now they basically created comparative advantage out of thin air. So the idea that it's natural and static is false. And then you get into, we're talking about U.S. tariffs. So guess what? As you know, the rest of the world has very high tariffs on all of our stuff. And then, the other factors are energy, which tends to be a world price.
Can I just stop you there,
Sure.
Jim? Because there is the other aspect of it that I really want you to address. That is, we are in quite an antagonistic relationship with China at the moment.
Correct.
So that being the case, do we really want to slap these tariffs on or increase these tariffs by a significant amount?
Right.
And that will be seen as an antagonistic gesture to China, which will then put China on more of a kind of war footing, which means that they will then look covetously, as we already know they're doing at Taiwan, but think to themselves, you know what is our relationship like with America? It's not great as it is. This is the moment to strike. I mean, that's a lot of people's concerns, aren't they?
Yes, you do hear that argument, but let me just,
Okay.
I'll come back to that point, but let me just separate them for a second. If China's annoyed or miffed or upset or whatever, who cares? I mean, that's not our job. Yeah, we got to be attentive to China, and we don't want to antagonize them needlessly. But if they have a sense of, we're being antagonistic to them, who cares? So they buy their soybeans from Brazil. Okay, you know what happened in 2018 when Trump put tariffs on China? China said, okay, we're not buying any more soybeans from the United States. We're buying them from Brazil. It was a huge disruption in the supply chain. It was one of the factors that fed into some of the inflation in 2022. A lot of it was government spending, but it wasn't that the tariffs were the sales taxes we described. It was that the supply chain was disrupted, which was also that had to do with COVID. But China shifted their soybean purchases to Brazil on long-term contracts, because I mean the logistics behind that are, the acreage, the port facilities, the transportation facilities. These people want 5-year contracts. They don't want a 6-month deal, et cetera. So what did the United States do? We sold our soybeans to the Netherlands. I mean, it's a big world. So yeah, we found another buyer. China found another seller, but we found another buyer. We're growing just as many soybeans, but we're selling them to Europe. And if China wants some, they can come and get it. My point is, a lot of these threats, there's a lot less there than meets the eye. And I'm not saying, by the way, when I talk about tariffs, I'm not saying global trade is going to go to zero, or it's the new Great Depression, or although that was titled one of my books, but it's not that there's no trade. And even if we have all this U.S. manufacturing, which I described, we're still going to need inputs from abroad. And these things can also be negotiated. Trump's kind of, acting with a pretty blunt instrument at the moment. And if no one wants to deal with him, it'll stay that way. But the door is open for talks, and certainly U.S.-Canadian car industry, they ought to figure out a way to solve that. But how do you solve it when Canada's been free riding for all these years? So I don't really. The thing is, Francis, you have to have the attitude you don't care. It's like, China's miffed, too bad. That's your problem. Figure it out. Why doesn't China reorient its economy to consumption from investment, half of which is wasted, by the way? I spent a lot of time in China. I mean, I've been to these ghost cities. You go to one of them, it's like say I got mud on my boots, but I got mud on my Italian loafers. But I did go out to the construction sites, and and I was actually had a couple Communist Party chaperones, and they were my hosts, and so they said,